Hello all, welcome to this new EnergyScan webinar session. We are going to wait 1 minute to let more people coming in. So welcome to those who just joined. It's now time to launch the first thematic webinar session of 2025. I'm Julien Waro. I'm in charge of the economic research team here at ENGIE Global Energy Management and Sales. And on top of our usual energy outlook webinars, we decided to organize several thematic sessions in 2025 to focus on specific energy topics. So we start today with one of the major regulatory change expected in the coming years in Europe, the new European carbon market, ETS2. So in this session, we'll give you the key elements to understand how the ETS2 fits into the EU net zero strategy, how the market has been designed, and what are the remaining uncertainties before the EU ETS2 enters into force. So I'm delighted to gather 4 speakers from the ENGIE group today to tackle this topic. Gerd Cooper, who is a senior manager at ENGIE Impact, Martin Schockert, who works as a greenhouse gas analyst in the regulation and market design team of GEM, Fabien Lefebvre, who is an environmental trader, and Paul Chavy, who is a carbon and power market analyst. As usual, check out the buttons on the bottom right corner of your screen to ask questions to our speakers or chat with participants and leave suggestions to the team. We'll do a Q&A session at the end of the presentation. Finally, you will also be asked to fill one question satisfaction survey at the end of the sessions. The slides and the replay of the session will be available by tomorrow at the latest on the EnergyScan platform. But you can already download the slides by clicking either on the cloud icon on the top right corner of the screen or following the instructions displayed here. So you just have to click on apps, then handouts, and you should see the PDF file with the slides. So let's start with the general introduction on the EU ETS2 and its position in the EU net zero target with Gert. So hello Gert, the floor is yours now.
Thanks, Julien, and good morning. So indeed, before we get into the details of the ETS2, I think it's important to explain first the more general framework where we have this discussion. So I can change the slide myself. So maybe start first with the view on the overall greenhouse gas emissions between now and 2050. So what we have in front of us is ENGIE's view that we also published last year, where we sketch a bit how we think that we should converge to the long-term goal of net zero emissions by 2050. So we believe it's achievable, but we have to increase our efforts. So far between 2010 and 2020, so we have indeed managed to decrease emissions on average by 2% per year. But forward looking, so we need to increase the speed, and we have to get to 4% annual reduction if we want to achieve the net zero by 2050. So it's achievable, but it's going together with a lot of efforts. We have to increase efficiency first. We have to electrify as much as possible, but we also have to complement with low carbon gases. You can find more on this just on the dedicated website. Now, this is a long-term goal, and it's not sufficient, because you cannot just say, so let's make sure we get to net zero by 2050, and let's hope that somehow the economy is converging to that long-term goal of net zero by 2050. So we have to do more than this. And so what we have to do is, in principle, translate these goals into legislation somehow to make sure that we frame a bit the economy in guiding the economy towards this long-term goal. And this is what has been done at European level over the last years. So it's somehow started with the European Green Deal, which is not a legislation but more a strategy, where we had set the goal of becoming the first climate neutral continent by 2050. So it's more general than just focusing on emissions, but for our goal and discussion here, so it's the net zero by 2050 that is the main, the key element of this strategy. Now, this strategy was translated into legislation that was done 2 years later by the climate law. That not just includes this long-term goal, but it also sets 2 other key elements. Because in the end, again, so it's not sufficient to have a legislation that says by 2050, so you have to be net zero. But you also to manage the transition towards this long-term goal, to make sure that we somehow are on the right path, and that we do not start too late with taking measures and taking efforts. Now, so what are these intermediate goals? So the first goal was that by 2030, so we aim to reduce total emissions, greenhouse gas emissions, so not just CO2, but greenhouse emissions by 55%. And the reference here is always the 1990 levels. And it was also said that we should define a process to define a target also for the 2040 reference year. And this is why the Commission, for instance, last year launched an impact assessment where out of which it came to the conclusion that, well, it recommends to go for 90% reduction by 2040. Now, let's focus first on this minus 55% reduction compared to 1990 levels by 2030. Well, again, so we had to translate this goal into legislation. So, and for that reason, a set of legislative pieces has been decided over several years, basically. That includes a series of rules and mechanisms to make sure that indeed we can reach that intermediate goal of 55% reduction. Now, this reduction is not cannot be done in the same way across all sectors, because sectors are different, and so this is why we have defined basically rules and mechanisms for 3 types of sectors. The first type of sector, so that's the emission trading scheme sectors, where we just say basically that, well, we define the total amount of emissions in the system, and we let people trade among themselves in order to make sure that we manage to achieve the goal at lowest abatement costs. And so this is the emission trading scheme that basically covers electricity and heat generation, energy-intensive industries, and commercial aviations. Now, we also have other sectors where we let the choice to member states to define their strategies in order to reach a goal, a reduction goal that is defined at country level, such that overall we reduce these emissions in these sectors by 40% by 2030. And so these are the effort sharing sectors. And among these sectors, we have also the buildings and the transportation sector. And then next to the ETS sectors and the effort sharing sectors, we also have everything related to land, be it land use, land exchange, or forestry. And this part has also in particular the ability to absorb emissions. And we have also set in the framework of this Fit for 55 package a target specifically for this sector, which is in terms of removals to be achieved by 2030. Note that already today this sector absorbs more emissions than it emits. So we have roughly a net absorption of 240 million tons per year. Now you see that the buildings and transportation sector is part of the effort sharing sector, but at the same time, so the reform of the ETS directive has set up this ETS2. So an emission trading scheme for not the existing one, but a new trading scheme that is focusing on the buildings and the domestic transport. And this is where the following slides are on. So we want to explain you a bit more how this ETS2 is expected to, or how is it first of all designed, what are the differences with respect to the existing ETS, and what are the future developments we may expect in the framework of this ETS2. And I think I can give the floor to my colleagues, to Maarten.
Yes. Thank you, Gert. Indeed, so let's dive into a bit detail. ETS1, it's in many ways similar. ETS2 is in many ways similar to ETS1. It forms part of the same overall regulatory framework. So it's also a emissions cap and trading scheme where emissions are kept at the EU level, where one emission allowance equals the right to emit 1 ton of CO2. There is will be auctioning of all emission allowances, and then there will be subsequent trading of them. There is also an annual compliance cycle, meaning that the regulated entities will have to monitor, report, and verify their emissions, and after that, they will need to surrender an equivalent amount of allowances. There is also a supply-side intervention mechanism under the form of a market stability reserve, just like under ETS1. And the annual union-wide cap is subject to a linear reduction factor. There are similarities, but obviously also differences. Unlike under ETS1, the regulated entity is not the emitter of the emissions, but is the fuel supplier. So ETS2 is essentially an upstream system. Also, the sectors are different, whereas ETS1 covers energy-intensive industries, ETS2 applies to buildings, transport, and small industry. Under ETS1, various greenhouse gases are in scope, and ETS2 is specific for CO2. There are no free allowances under ETS2, and the trigger for the surrendering obligation is not the combustion and release of greenhouse gas emissions, but because of this upstream nature, it is the release for consumption of their in-scope fuels, on which we will discuss later on. There are also compensation measures under ETS2. They are not in the form of state aid, but member states will be able to draw specifically from a social climate fund to finance national support measures. ETS2 sectors are already covered by another regulation, which is the effort sharing regulation, imposing national targets upon member states. The market stability reserve allowances can be put in the reserve and released from that reserve based on certain triggers. So under ETS1, those triggers depend on the total number of allowances in circulation, or TNAC. So if it's above a certain level, then a number of allowances are put in the reserve. If the total number of allowances in circulation is below a level, a number of allowances are released, and there is also a release in case of a significant price increase. There's a similar mechanic under ETS2, but in addition, there is a de facto price cap, or at least price level trigger, where an additional number of allowances will be released if allowance price exceeds 45 euro, which is the 2020 value and indexed annually. So what is the scope of ETS2? So it's an upstream system targeting entities releasing fuel for consumption for customers in specified sectors. So the relevant commercial heating and motor fuels that are in scope, they are defined in the Energy Taxation and Excise Directive. So it's essentially petrol, gas oil, kerosene, LPG, natural gas, and some others. And so each supplier will have to identify the fuel stream that are potentially in scope of ETS2, and then for each of such fuel stream, it needs to check whether the customers are in the relevant in scope customer categorization. And for that, ETS2 is referring to the common reporting format that were established under the IPCC 2006 guidelines. So the relevant sectors are the building sector, so it relates to fuel combustion in residential, commercial, and institutional buildings, road transport, so all combustion of CO2 emissions from fuel use, so cars, motorcycles, light and heavy duty vehicles, and then also other sectors, so smaller scale industry, so essentially energy, manufacturing, and construction, to the extent not already covered under ETS1. So each supplier will need to identify the fuel streams and will need to identify in-scope customers, and that will then, based on the degree to which its customer are under scope or in the scope of ETS2, will need to define a scope factor. And so each supplier will have to do a calculation where he will multiply the fuel stream quantity times a scope factor. So here in the below example, it's, for example, 90% of a natural gas supplier's portfolio or in scope of ETS2. You will then have to multiply that with a conversion factor into terajoule, then apply the applicable emission factor and eventually and maybe deduct a biomass fraction to come up with the total amount of emissions. It's also important to note that member states have the option to unilaterally opt in certain sectors into the ETS scope then on a national level. For example, you know that Germany has chosen to do that for agriculture and rail transport. ETS2 is a cap and trade model, so it will be a parallel circuit to ETS1, so there is no direct link between the two. There are no free allowances as said. The 27 cap has been fixed at just over 1 billion allowances, and there is an annual reduction of the cap of 5.38%, subject to certain conditions. In the first year, there will be a surplus of 30% of allowances to be auctioned, which will then be deducted over the period from 29 to 31. The market stability reserves functions based on two sorts of trigger points. So the first one is TNEC, as explained. So if TNEC is above 440 million, 100 million of emission allowances will be banked. If it's below 210 million, 100 million of allowances will be released. And there is also an additional release in case of excessive price or in case of exceedings of the price cap. The compliance cycle of ETS2, it's similar to ETS1, so it means that every regulated entity will have to establish a monitoring plan that it will pursuant to which that entity will have to monitor its emissions throughout the year, and after the year draw up an annual remission report, which will then have to be verified by an accredited verifier, following which that entity will need then to surrender the required amount of allowances on the union registry. And then maybe some specificity. So for biogas injected in the grid, the monitoring regulation, and it's also confirmed by the Commission's monitoring guidance, confirms that a biomass fraction for the supply of biogas may be taken into account. The conditions for such use will be that it's determined based on purchase records, that there is no double counting. So it essentially means that if there is a go, the go needs to be linked with the proof of sustainability. And this link will need to be evidenced by the relevant biogas registry or database, or alternatively that there was no go issued. And of course, the biogas need to meet the RED II sustainability criteria. And then finally, as said, there will be a social climate fund established at EU level to in the period 26 to 32. The fund will provide financial support to member states for measures and investments that they can include in their national social climate plans. The aim is to protect vulnerable customers, and it will be funded through proceeds of part of the emission allowance auctions. So this fund should mobilize at least 86 billion euro of public funding over this period. And I pass now the floor back to Gert.
Oops. Yes, thanks, Martin. Indeed. So we also had a look where actually member states stay in terms of reductions and measures taken to reduce emissions in the buildings and the transport sector. Because in the end, so we do not know exactly where the price of the ETS2 will be once it starts in 27. But there's also then the discussion on how member states can manage the transition between now and the ETS to go live in 27. So there's also a question of convergence to be managed. And what can help is, of course, that if member states have already taken some measures at national level. We did not do a detailed review by member state, but what we have seen is, for instance, that, well, for instance, in France, there's not really a mechanism set up to manage these emissions in these sectors with a formal mechanism, while on the other hand, in Germany, for instance, we have already somehow a similar mechanism that is that has been defined already in 2019. And so it's in principle, it's designed in a very similar way. It's meant to be a trading system, so a cap and trade like the ETS2 or the existing ETS, where the suppliers of fuels have to participate and to buy certificates for the emissions related to the fuels they sell. And there is also a transition phase that is planned. So in the first phase, there's no endogenous price that comes out of the trading. So the price of the allowance is fixed, going from 25 euros per ton in 21 to now in 25, 55 euros per ton. So as of next year, so the idea is that Germany will converge to a price that is set by the interaction of demand and supply of allowances, with nevertheless a price corridor. At this stage, I'm not too sure, but I don't think so. It's still a bit the question whether they will indeed go to this price that is set by auctions, or whether we will keep the price fixed for 26 before the system will be replaced actually by the ETS2 as of 27. So that's just to illustrate that well, the situation at member state is very different, and that means also that the convergence towards the ETS2 in 27 may also be very different across member states. And then I hand over to again to Paul or Fabien. I'm not too sure who is starting.
Hi, everybody. Thanks again for being here. It will just be a very short intervention on my side for now before I let Paul introduce part 3. But yes, to add to emphasize what Gerd just presented, Germany indeed had a carbon market already. So there's a lively discussion going on regarding the convergence with the existing mechanism into the future ETS2 market. But France typically, as he said, is a very different animal because there's no carbon market per se in France. It's a very touchy subject. Everybody remembers the Gilets jaunes movement, etc. So there's already a fossil fuel tax with a carbon emission target, but it's completely fixed by the government. It's nowhere near a market mechanism. So the articulation of the existing fiscal scheme and the future ETS2 market is still a very open subject. General takeaway indeed is that although the ETS is a consistent European directive, well, the national transcription into local law is each time very specific, depending typically if there's an existing carbon market or some sort of carbon market already existing, or typically if local authorities have a strong ambition, typically regarding the opt-in or opt-out of the agricultural activities. So in a nutshell, and that's something is very paramount. As a compliance player, you really need to liaise, if it hasn't been done already, with your local relevant governing bodies to assess how to comply and what will be, although everything is not certain as of now, but at least to have some hints as to how will the ETS2 transpose into your very national legal framework, because in the end, your registry will be managed by the local state, although the market is European-wide. But we'll come to the market later on. Thanks, Gert, and back to you, Paul, for next part.
Thank you, Fabien. So now let's dive into the outlook and the uncertainties of the EU ETS2. So first of all, it's important, I think, to step back and to look at the historical data on the sectors covered by the EU ETS2 and the cap trajectory set by the EU. So on the left chart here, we have the emissions from the road transport and building sectors over the past decade. And on the right chart, we see how the cap must evolve once the EU ETS2 is implemented. So the graph on the left shows that emissions from these sectors have remained relatively stable, with only a small decrease in the past decades, only minus 4% between 2014 and 2024. So this highlights really a key challenge that these sectors, unlike those under the ETS1, have really struggled to reduce their carbon footprint in a meaningful way. And this stagnation reinforces why the EU ETS2 is being introduced to provide a stronger incentive to cut emissions. And now if we look at the right on the graph, we see that the planned cap trajectory for EU ETS2, the target is very ambitious. By 2030, emissions would be reduced by 42% compared with 1990 levels, and by 70% in 2037. But will carbon prices will be high enough to effectively drive decarbonization, because the transition will require large-scale adoptions from electric vehicles, for example, or heat pumps to drive down the emission of these sectors. So now let's focus on price sensitivity, on switching prices. So how fuel prices react to changes in CO2 prices, and at what carbon price the transition to low carbon alternatives. So here I took the example of electric vehicles and heat pumps becomes financially viable. So first, let's consider how carbon pricing directly affects fuel costs. So here you can look at the bottom. So each liter of diesel emits approximately 2.6 kilograms of CO2. So to give you an idea, to carbon price of 50 euros per ton, the additional cost per liter is 13 cents. And similarly, for the gas, 1 kilowatt hour of gas emits approximately 0.2 kilograms of CO2, meaning that at a 50 euros per ton price, the cost increases by about 10 euros per megawatt hour. And this will impact directly household heating bills and industrial energy costs. And as carbon price rises, this additional cost will become even more significant and accelerating the shift toward a cleaner alternative. But when does it make economic sense to switch? So here are two graphs that illustrate the pivot points for switching based on discounted costs that account for all relevant costs, meaning upfront costs and costs in the future that are discounted into the present, and that in function of the carbon price. So if we look closer at the left graph, so this is a comparison of the cost for electric vehicles and thermal vehicles. So we have the cost of electric vehicles and the cost of thermal vehicles on the ranges that varies considering several parameters. So it will depend first on the upfront costs, but also on electricity costs, the kilometers driven per year, the battery replacement costs, and also interest rates, also to discount this cost into the present. And there is one particularity for trucks to consider is that the profitability of trucks, as they have less autonomy than the combustion ones. And obviously, as you can see, the more EV the vehicle, the more sensitive it is to the CO2 prices as it consumes more fuel. And on the right chart, it's the comparison between heat pumps and gas boilers. So the same analysis apply to heating systems, where the break-even depends on factors like upfront investments, energy consumption, electricity prices, and financing costs. So first of all, what you can see is that the ranges are very wide, and the level of complete switching towards cleaner alternative be very high in terms of carbon prices. And furthermore, and I think this is very important, is that this switching is when you have the option to choose between the two options. But let's say you already have, for example, a thermal vehicle, so the upfront cost of buying a car is already taken into account. So you would only have to bear the future costs of your thermal vehicle, and so the marginal cost to switch would be much higher, which means that the CO2 price must be even bigger than that. And I think this is also key to understand, is that there are many parameters to take into account. On the CO2 price is only one into a lot of elements. And even though it creates an incentive still, bear in mind that the ETS2 and the carbon price of the ETS2 is part of an overall plan to decarbonize the European economy. And finally, let's talk about forecast emissions and balance. So first, on the right chart, we can look at the mix that we use for this balance to forecast the emissions. So for the road transport, it will involve diesel, gasoline, and biofuels for the emissions, and for the buildings, gas, fuel, and solid fuels, which is coal and wood, for example. So now, if we look at the chart on the left, so on the balance, so the key takeaway to look at it is that the market will start with an oversupply in 2027, but it will sharpen tightly between 2029 and 2031. So let's see why. Because as Martin already tell, so the market will start with a total cap for the first year of approximately 1,000 million tons, with no free allocations, meaning that all allowances must be purchased. However, an additional 310 million tons, so it's 30% of the cap, will be introduced in 2027 to ensure market liquidity. So this means that at the very beginning of the market, there will be relatively few constraints on the market, with more allowances than immediate demand. However, from 2029 to 2031, the market balance will shift completely, as the 30% of provided in 2027 will be deducted from auction volumes during this period, and effectively tightening supply. And additionally, the linear reduction factor, which will gradually decrease the total cap. And to complete also what Martin told about the MSR, it will be key in the balanced supply, because, for example, if the average allowance price exceeds 45 euros per ton for 2 consecutive months, 20 million allowances will be released from the MSR, and this is twice a year. And bear in mind also that we often talk about that 45 euros threshold for the EU ETS2, but it is considering 2020 euro value. So given the inflation, it will now be more about 55 euros in 2027, even 60 euros. And if the prices rise too fast, also more volume will also be added. So that's why on the balance, you can see that after 2031, the MSR could have a clearly more important impact, as the emission will be hard to get down, harder than those of the ETS1 sector, meaning that the supply, and therefore the MSR, will impact importantly the market. So in summary, we expect a relatively loose market in the early years, brought by a very sharp tightening from 2029 onwards. And to conclude, the final balance will depend overall on real-world emissions reduction, technological adoptions, so the electric car fleet, for example, and how the MSR interventions play out in the year after 2030. I now leave the floor to Fabien.
Thanks very much, Paul, for this very thorough dive into the technical and the potential balance of the EU ETS2. So I guess that leaves us with a tiny but quite important question of what would be the price. Well, Hélas, as you understood, there's no straightforward easy answer to that. And before we get to that, if I may, I think it's not useless to come back to the fundamentals of a cap and trade system, and more specifically of the EU ETS, the existing EU ETS, so what we could now call the EU ETS1, which has been in place now for 2 decades. So it's a cap and trade. So what's the cap? It's the discretionary mechanism by which the Commission sets a maximum amount of emission allowances and puts them into circulation. So that's the cap. It's quite easy. So the EU institutions control the scarcity of those units, and they may ease or increase the tension on the market, because in 2010 it was the exact opposite. Today we speak about MSR as an ease mechanism where we would inject additional liquidity if the market would spike too much. But in 2010, carbon was very much dismonetized, and the market stability reserve was actually a mean to withdraw allowances from the market and prices to pick up. So that's the complete discretionary mean by which the Commission may set the price towards a level that it deems enough to put a carbon constraint, but not too harsh so that it doesn't kill competitiveness, because I see in your questions that it's an issue we all have in mind. But it's important to remember that any intervention on this very discretionary market indeed remains indirect, because it's always volume-based. The price fixing process is dealt with on an open market. So that's the trade process. And by trade, when we speak about the carbon market, it's actually a two-leg market. There's what we could call the primary one. So it's the simple channel through which the EU Commission pours allowances into the markets. So it's done through an electronic auctioning system. So every couple of days, 2-3 days, some millions of tons are put through an electronic platform, and the highest bids wins the lot. That was given for almost all EU countries to the EEX platform, which has a mandate to organize this EU ETS auction. So that sets the original price for the very short term EUA to be directly injected in the economy. But it doesn't stop here, and actually most of the market is what we call the secondary markets, meaning that aside from this direct auction channel, several players may, on a completely bilateral way, buy and sell and rebuy and resell EUAs again, with a very large variety of possibilities, typically future deliveries, because whenever you buy on the auction system, you're going to be delivered within the next 2 days. Secondary markets, you can negotiate through platforms or directly with counterparts deliveries as long as 5 years in advance. So if we get to next slide, which depicts a bit more of this concrete price of the EU ETS1, but I guess most of you are familiar with it because we've been living with the EUA1 for quite a time now. EUAs are electronic products, so they behave like a physical commodity, but it's because they are delivered in the end. But it's merely a writing on an account, so there's no storage cost whatsoever. There's no expiration dates. So carbon price reflects not only the offer and supply balance on the long term, but also very much the interest rate. And the mere difference you'll have between an EUA delivered today or in 3 years will be the cost of money, basically. Something which is quite important to grasp as well is that the European market is quite speculative and frequently volatile, because it's clearly in the EU. it's in the EU philosophy to welcome this surge in liquidity, because they believe that aside from compliance player, which just want to buy EUAs to up to their commitment, you're going to have funds or banks which are going to enter the market on a much more speculative approach to basically make assumptions on the market and get out of it with a premium. But it is welcome in the way that it provides liquidity, because if you only have compliance player, well, then most of them will be single buyers. There would be no offer. So in the EU market-based philosophy, there's a regulation indeed, but there's also a free market approach, and it comes with a rather efficient indeed, but sometimes a brutal price making process. It's more or less, as we speak, stable around 70 euros right now, but it's been ramping up all the way to 100 euros during the peak of the energy crisis back in 2022. It's also important to grasp that what we call the secondary market in terms of volume massively outstands the primary one, because the volumes are bought and sold as many times as one desires. So it's a very, very big market in terms of churn ratio and sums involved. All this to say that there's no reason to believe that the EU ETS second stage, so the EUA2, which will be a new product, it will not be the same as it's not going to just add demand within the same certificate. It will be another certificate, but there's no strong reason to believe that it should be very different from the EU ETS one. The institution's philosophy have not changed. There's still a mean to have a regulation leg and a market leg. EU ETS has proved efficient because, on the contrary to households and automobile sector, well, we can see that in the EU ETS one hit sectors, so heavy industries, energy making, etc., the carbon saving was massive. So if there's one thing we may say about the ETS1 is that it works. So in all likelihood, the ETS2 will be a very similar mechanism. So that gives us strong hints on how will it trade. It will probably be a financial market, well, physical market in the way it behaves, but financial in the way it's regulated. So with MiFID regulation, etc., etc. And in terms of timeline, well, that brings us to the core of the issue. Actually, is that nothing is to be expected in terms of concrete and tangible certificates before the start of the compliance. So entities delivering fossil fuels within the ETS2 will need to comply by 1st of Jan 27, and the EU Commission has made very clear that it does not expect to put any available certificates in an auction before that. All the more because the auctioning process will be reopened. There will be a new tender, and EEX mandates will expire end of 2026, just before the new framework starts. So it will all be reset. So although we were pretty sure of how it's going to work, there's nothing official yet, and there's no certificate. So if there's no primary market, well, it's quite difficult to set a secondary market with a price plus interest rate, given that nobody has seen any EUA 2, and for a very good reason, they still don't exist. But that's a crucial point because, as many of you are aware, that energy sellers are already committing volumes on the sell side beyond 2027. So concretely, they're building up short position on something that doesn't exist yet. So it's a clear issue, and it's many legal and paperwork are being dealt with to put in forward contracts the fact that there will be an EEA2 component. We just don't know how much it will cost yet. So that's for now more, I would say, a legal issue than a clear trading issue, because there is no market. But it may not be as rude as I would say as brutal as 1st Jan 27, because as you probably heard in the news, those big platforms, EEX, the International Intercontinental Exchange, have probably big business to do with such a potential huge market, because it will be as big as the ETS one, given the allowances. So they already launched future products. So most likely by the end of 2025, we will have electronic platforms with margin calls, etc., the whole dish, allowing people to trade with a skeleton of a real framework to trade EU ETS2 allowances. So maybe some speculative player will actually try to play the liquidity before it even starts and start proposing price level, anticipating that when there will be tangible certificates, they should be lower than or more profitable than the position they offer. So there may be hedging solutions that will arise a bit before actual certificates come into circulation, but it can only be an assumption, and we have nothing as of now any close to a price level. Of course, we've been discussing this for more than half an hour now, and I'll soon leave the mic for questions, but we have global balances, we have EUA1 levels, we have MSR triggers. It gives a strong idea of where the Commission wants to set the carbon price. When you see that there's an MSR trigger at, say, 60 euro value 2027, well, we know that 60 euro starts to be a stress scenario where they start hitting the brakes and trying to limit the price. So we see that that's a strong input. Now we see that ETS1 are at 70 euros. So we somewhere around this is a very reasonable assumption. If you need to work a scenario or risk-based approach, 60, 70 euros seems sound and reasonable, but it's not a market. It's only an assumption. It's only a scenario, and we cannot propose anything better as of now. But of course, at ENGIE, we're very much involved in certificates and green energy and energy in general. So it's something which we're going to monitor very closely. So through EnergyScan and your usual originators, we will have whatever useful news as soon as it comes, and whatever hedging possibility as soon as we may have a market, because we will be present on it, of course. And I'll leave the mic to our dear moderator, and I guess for questions you may have.
Yeah. Fabien, thank you. Thanks to all our speakers. Thanks for your attention. So it's now time to move on to the Q&A session. So let me remind you that the next webinar session and another thematic one will take place in April with a topic to be defined. So let's go to the chat room where we have some questions. So first question, maybe for you, Paul. Question about the data. Where can we find data about the thematic and the total emission per year?
Well, good question, but as you can see, it's only forecast total emissions that I show on my slide, and the total emissions will only be available on the market is open so in 2027, and as the same as the TNIC, because the TNIC is only a calculation between supply, demand, and what the MSR holds into allowances. So for now, we cannot find it. We will only have to wait until 2027.
All right. Next question, maybe for Martin or Gert. Will the CO2 emission related with biomass combustion plants be under the EU ETS2?
Yes, maybe. So the in-scope fuels are the ones that are defined in Article 2.1 of the Energy Taxation Directive, and so it currently does not include biomass chips, and so such combustion plants will likely fall under ETS1 if they exceed the 20 megawatt threshold.
All right. Third question. So regarding the geopolitical context and of course the moves, the change of paradigm between the US and China, and also the last revision of CSRD obligations. Could the ETS2 be postponed by 1 or 2 years, or even more, to or be softened in the coming months in the current political context regarding the energy transition?
Difficult to find a good answer to that question. So indeed, but I just can give a few elements to that question. So first of all, so in terms of maybe international competition, so I would say that the ETS2 sectors are subject to less competition than ETS1 sectors. So I guess the problem of leakage, etc., is less of an issue. So it's more the question, what is the cost for the consumer in the end of the ETS2? And indeed, so we can expect that the cost is increasing. But maybe a few elements to that. So first of all, maybe the recent, and that's my personal so answer to that is, well, the recent evolution has maybe shown that it's even more important to get independent from gas and oil. Of course, climate change has not changed, so we need to reduce emissions somehow in the transport and buildings segment as well. And we have seen, so we did not do enough in the past years, so we have to do something. And so the challenge will indeed be to make sure that we give the efficient signal to the consumer, so put a price on CO2, but at the same time, of course, foresee a mechanism to compensate some consumers from the increased cost without changing the incentives to reduce emissions. I didn't hear anything about a postponement, but I think that might not be the good signal, because in the end, climate change is not away. As I said, so we need to foresee a mechanism to somehow compensate some consumers for that increased cost. That would be my answer to that.
Okay, thank you, Gert. Next question. So how biomethane guarantees of origin will be compatibilized for the ETS2? What is the role of proof of sustainability? So maybe Martin on this.
Yeah, so the biomass fraction under ETS2, like under ETS1, will be based on the proof of sustainability, which are the instruments that are issued to evidence compliance with the RED II sustainability criteria, and these are the relevant to use under ETS2. The only requirement, as mentioned in the slides, is that there cannot be double counting, and to ensure that, either the regulated entity will need to demonstrate that either there was no guarantee of.
We don't hear you.
Some connection issues with Martin, I guess. Martin? Okay, so maybe we'll switch to the next questions, waiting for Martin to go back. Questions regarding the energy transition as a whole. So we see that the share of fossil fuels remains close to 80% on the total energy mix, which indicates that only certain countries invest in the green transition to remain competitive. Given the competitive global market, what mechanisms does the EU have to support significant capital investments in green energy while maintaining competitiveness?
Yeah, again, so that's a very large question, very large in scope. So, but there are indeed, so this maybe first of all, it's so with this shares, we have to be clear on what we are looking at. Do we look at primary energy consumption, or do we look at final energy consumption? And depending on the view you take, well, the importance of renewable energy is very different. So that's maybe the first element. The second element is that, of course, competitiveness is an issue, and so there are several. What we have seen, for instance, at electricity prices, that industrials here in Europe are exposed to a much higher, more than double than what in US industrials have to pay for electricity. So it is an issue, and there are several mechanisms to to compensate. So there are of course support mechanisms for renewables. There's the carbon border adjustment mechanisms and other funds that are meant to somehow reduce the effect of these increased costs. But in the end, the hope is also that renewables are further decreasing. The cost of renewables are further decreasing in the end. That might reduce a bit the gap in competitiveness.
Thank you, Gert. So another question, lots of questions. Thank you for all these questions. So if you are on the supplier side and you supply fuels to companies which produce products to sectors covered by the ETS2, but their factories are all part of ETS1, are you exempted or do you need to report and come to conclusion that you do not need to surrender ETS2 allowances? I don't know if
well, from what we've seen from the regulation, and then again, it's an ongoing process, but something which is quite sure is that it's the direct link to your customer and the classification of his customer himself, no matter what he does with the energy, which will define the eligibility of the megawatt hour to the ETS2 or being it out of scope. So typically, if you sell concrete examples, if you distribute natural gas, so with a strong fossil component to households, that is ETS2. If you distribute this natural gas to a small bakery or a tiny shop, it's ETS2 as well. But if you distribute gas to a cemetery, whatever the cement will be used for in the end, the cemetery is within the ETS1 because it's a big factory. So heavy industry, already ETS1. So typically in your monitor, report, verify scheme, you will have all your fossil cells and you will say, well, this, given typically the fiscal classification of my direct customers, these are ETS2. These are non-ETS2, and then you multiply. It's your scope factor, which you combine with your total sales. So if you sell to a ETS1 eligible plant, whatever the output will come from that plant, the carbon combustion based on the fuel you've sold is already dealt with in the ETS because it's ETS1 covered. So no, you won't have an additional issue with that.
All right. Thank you, Fabien. So one last question. So don't worry for other questions. We will take the time to answer them by email after the session. One last question, still on the supplier side and the supplier obligations. You mentioned they would be the ones checking the scope for their client. Is this correct? So maybe Martin, if you are back.
Yeah, I'll try. Do you hear me?
Yeah.
Yes.
We can hear you now.
Yes. So each supplier is required to monitor its emissions. So it needs to assess to what client it is supplying. Yes.
Good. And an additional question, but I'm not sure we have an answer to this. Do you have any idea of how the cost will be passed through at ENGIE or other suppliers?
Well, it's as I've said, it's for now. It's still an ongoing question because it's difficult to pass on the cost without having any sort of price reference on which you could base your contracts. General philosophy, but it's not something really new. Would be a pass through to the end customer, which at some sort puts a mutualization on European citizens of the cost of decarbonization, and within it, basically, it will be competitive. So as all the components of the cost, your supply chain, the initial molecule which you buy, and how you manage your certificates, it will be a mean to be more or less competitive than the other players. But typically, if in France, if you've heard of the certificat d'économie d'énergie, there's already a strong obligation linked not so much to carbon emission, but to the absolute energy consumption within households. So CEEs are meant to finance insulation. Well, typically that is passed on to the global cost of energy. So there is indeed an inflationary perspective. The corporations do not have the possibility to digest such certificates given their price and just lower their margins and pass nothing on to the end consumer, because the certificates are actually much better than the operating, much higher than the operating margins of natural gas or fuel distribution. So it will be a pass on, but to what extent will this pass on be compensated by fiscal measures, which is the exact mean of a social climate fund that remains to be dealt with by governments.
Okay, thanks a lot for your answer to Fabien and to all our speakers. Just before we close the session, we would like you to answer a very short one question satisfaction survey. So thanks to take a few seconds to answer, because we need your feedback. It's always valuable to us. So I will let you a few seconds to answer. So thanks to those who took the time to answer our survey. So it's now time to close this session. I hope you enjoyed it. And so see you soon on the EnergyScan platform for more information about the EU ETS2. We will also put some basic informations in the platform, and also some useful links towards the documents that can be useful to know more about the ETS2 and the local implementation. So see you soon in EnergyScan, and goodbye.